some of the short-term sources of finance, because obviously it is preferable that the short-term assets or the current assets be financed through majorly through the short-term sources. But let us see what are the alternate approaches which are available to the financial manager of a firm with respect to working capital financing. So the first approach under the alternate three approaches available is the hedging policy. Hedging, if we talk about an investment, it is trying to safeguard yourself from risk, okay, avoiding the risk. With respect to working capital management, it is more of a matching policy wherein the firm tries to match the duration of the assets with the duration of the liabilities which are used to finance those assets. So, current assets, you're matching the duration, the life of the current assets with the short term sources of finance which you are using to finance them. Similarly, when I talk about fixed assets, since they have a longer life, we will use long-term sources of finance to finance the fixed assets of the firm. So if you see, if there is a 10-year, the firm has purchased an asset, a machinery of life, expected life of 10 years, then the firm will try to raise a matching loan of 10 years to finance this purchase. Okay, on the other hand, if you need finance, you need funds for maintaining 1 month of stock in your business, then that can be done through a short-term loan taken by the firm of equal of matching duration. So this becomes a medium risk policy for the firm. You are not locking in excess funds in your working capital. You are picking up each and every short-term asset and long-term asset and looking for sources which match their duration. So this is how it looks like. See, have a look at the graph. You have the amount of working capital on the y-axis and time on the x-axis. So as discussed earlier, there are some permanent working capital requirements for the firm. Then there are some temporary working capital requirements for the firm in the business. Hence, you have some permanent current assets and temporary current assets. जो लॉन्ग टर्म सोर्सेज ऑफ फाइनेंस हैं वो आप यूज कर रहे हो फॉर फाइनेंसिंग द फिक्स्ड एसेट्स and the permanent current assets of the firm, while short-term sources of finance are used for the fluctuations in the requirement of current assets, जो हम temporary working capital भी बोलते हैं in gross terms. This is the midway approach. On the other hand, the other two approaches are extreme approaches, जो हम अब बात करेंगे. After this, the next approach is the conservative approach. So this is the approach to avoid risk completely. So just by looking at the graph, you can see the emphasis is on long-term financing. You are focusing more attention. You're not only using long-term financing for financing of fixed assets and permanent current assets, but even for the temporary current assets, you are trying to a large extent to finance them out of the long-term sources of finance. Now, this approach is very conservative. It means that in terms of solvency of the firm, this is a very safe approach. इसमें रिस्क बहुत कम है, पर रिस्क कम है, रिटर्न भी कम होगा क्योंकि कॉस्ट ऑफ लॉन्ग टर्म सोर्सेज ऑफ फाइनेंस इज हायर than short term sources, and hence In terms of profitability, this approach is not very good for the firm. Liquidity obviously is high, but profitability will be low as the cost of raising these funds will be very high for the firm. This is a no risk approach, aggressive policy, counter opposite. The firm is assuming a lot of risk under such kind of financing scheme. You can see that long-term sources of finance are being used only for the financing of fixed assets. After that, permanent current assets come major part, and your temporary current assets all are being financed from short-term sources. For short-term sources, as I told you, will have a lower cost for the firm. So it will improve the profitability, but the risk for the firm also increases to a large extent, and hence this can be a very risky proposition for the firm to follow an aggressive policy of working capital management. Okay, because you are depending more on the short-term sources of finance. So when the finance manager is deciding on how to go about with working capital management, aggressive approach should be avoided. Hedging would be a midway because aggressive and conservative are at extreme ends and they both have their negative implications also, which we can summarize through this table. So first factor for comparison of the three approaches is the factor of liquidity. Obviously, under the conservative approach, the liquidity will be very high because you are using so much of large long-term funds. So you have enough liquidity in your business to meet unforeseen demands. Aggressive will have very low liquidity because most of your funding is dependent on short-term sources. Long-term sources are used only for permanent assets, fixed assets, or permanent or some part of the permanent current assets. A balanced approach is the hedging approach. Then liquidity and profitability, they work in opposite directions. So if you talk about profitability, then conservative approach will give you a low profitability, aggressive approach will give you a high profitability, and the hedging approach will be in between them, giving a moderate profitability. Yeah, I'll come back to this slide. I think there was a lag. So this is how the profitability looks like for a firm under the three alternate approaches. Then the third point is the risk under conservative approach, very low risk, aggressive high risk, and balanced risk under the hedging policy. Asset utilization ratio. So, to what extent is the firm using its current assets? The conservative approach has a low asset utilization ratio because you are tying up the assets with long-term finances, while aggressive approach utilization ratio will be high and hedging will have a moderate value. Then under conservative approach, since you are blocking so much of funds in long term finances, your working capital requirement will be on the higher side as compared to the aggressive and hedging approach. So this is what the picture is like under the three approaches. Okay. If there are any questions you can ask. We now move to we have done the calculation of operating cycle. Now we move to the calculation of working capital. Estimation basically of working capital requirement for a business. So there are a number of methods which are followed, but in continuation of the operating cycle, first I will take up the operating cycle method approach basis for calculation of working capital. And then I'll briefly give you an overview of what are the other methods which are followed. If we talk about the current method, which is based on operating cycle, working capital is the net of current assets and current liabilities. And this is what is the format which is followed. Under current assets, you first calculate the amount of current assets required in terms of minimum cash balance, funds locked up in the inventory conversion period, then debt collection period. This is similar to what we did in the operating cycle also. First, we sum total the conversion period and the debt receiving period, the debt collection period, and less the debt payment period. तो यहाँ पर आप करंट एसेट्स में इन्वेंट्री को कंसिडर कर रहे हो कि कितने फंड्स आपके इन्वेंट्री में ब्लॉक्ड हैं, उसमें आप you are seeing how much funds are locked in raw material, then in work in progress. Now, work in progress may be the units under work in progress may be at different stages of completion. कुछ यूनिट्स पर 50% काम हुआ होगा, कुछ पर 80%, कुछ पर 95% भी वर्क completed होगा. So an average rule is followed while estimating the requirement of funds in work in progress, or how much of funds are blocked in work in progress. We divide work in progress into three categories: raw material, wages and overheads. तो इन तीनों के पर्सपेक्टिव से कितना काम हुआ है, we take an average amount. It is assumed that with respect to raw material, there is 100% completion. Because it is only when you get purchase the raw material that you can start working on the production part. So with respect to raw material, the work is 100% complete. But with respect to wages and overheads, we say that 50% of this is complete under the work in progress. Okay, so how this is valued, we will take up practical questions. But this rule you need to memorize. With respect to raw materials, 100% of work is complete. But with respect to wages and overheads, 50% of the work is complete. Then when you value the finished goods, how much investment needs to be made in finished goods, then they are taken at the cost of goods sold. Okay, that is the sum total of all the cost of production. You take up finished goods are valued at the cost of goods sold. Then for receivables, they can be in form of debtors or bills receivable. They are valued at the cost of sales. Does anyone remember what was the difference between cost of goods sold and cost of sales? How do we move from cost of goods sold to cost of sales?
By subtracting the traveling expenses and selling expenses.
Yes, absolutely right. By adding up the selling and distribution expenses, we come to the cost of sales, और फिर उस पर profit margin add करके हमारा selling price आता था. बट जब हम करंट एसेट्स की बात करें, वी आर नॉट including the profit margin here. Everything is being taken on the cost basis. So you add up the amount for all the current assets, you get the gross working capital requirement. You deduct the current liabilities from this, you will get the net working capital. Now, under current liabilities, we have creditors for purchases. Creditors are for raw material. So, estimation is made at the raw material cost per unit. देन क्रेडिटर फॉर वेजेस एंड ओवरहेड्स, जो भी वेजेस की पर यूनिट कॉस्ट आपने कैलकुलेट करी है या ओवरहेड्स की, ये वहां पर क्रेडिटर्स होंगे जो भी लैग हो रही है पेमेंट की. So say the firm is making the payment for wages and overheads after 1 month or 2 months, that will be specified. We accordingly calculate the amount. Okay. And safety margin will be a kind of buffer for unforeseen emergencies. This point I'll take up in practical question and as and when it comes. But we'll first start with simple questions on estimation of working capital requirement. So let us see the first question. Now you are given the production for a firm. You have to estimate the working capital requirement. Production is given on per annum basis, while the other information, if you have a look here, it is on monthly basis. What is the time period for which raw materials are stored? What is the work in progress storage period and everything? So which means we need to do the calculations on monthly basis. Okay. Now after that you are given raw material wages overheads as a percentage of the selling price, and you need to calculate what is the working capital requirement. Which means as per the question, we'll first calculate the gross working capital minus current liabilities and we'll get the net working capital. So let's start with the question. So step 1 will be calculation of individual cost. So raw material rupees 3 per unit, wages 0.5 per unit, and overheads rupees 1 per unit. You can see that the total cost of goods sold or cost of sales is 4.5 rupees, 4.5 per unit, which means there is a profit margin of 0.50 on every unit sold. So this was step 1. Under step 2, we start with the calculation of gross working capital. So we are estimating all the current asset. If the production for the complete year is 60,000 units, then for monthly production will be 5,000 units per month. Okay, so the first current asset is the cash balance. Now we'll start with the other current assets. First is the raw material. Just have a look as to how these values are being calculated. So the monthly production is 5,000 units. For 5,000 units, the raw material cost will be at the rate rupees 3 per unit, and the holding period is for 2 months. So this will be your raw material requirement. So this is coming to 30,000 rupees. This is the amount that is logged in raw materials on monthly basis. Okay. Next element is work in progress. So I was telling you that under work in progress we have three elements. You have the work done with respect to raw material, labor, and overheads. So let us see how this is calculated. With respect to raw material, 5,000 into 3. This remains the same, but your work in progress storage period is 1 month. So this will be the value of raw material held in work in progress. Then wages, again for 5,000 units, cost per unit is zero point 0.5 into 1 month, which is the holding period for work in progress. But the wages are taken, both wages and overheads are taken at 50%. So you need to multiply this amount with 50 into 50 by 100. Similarly for overheads also, again 5,000 is the monthly production. Every unit is incurring an overhead cost of rupees 1, and the storage time is 1. So wages and overheads will be taken at 50% of the value, while raw material will be taken at 100% of the value. So let us see what is the total amount coming to. It is coming to 18750. Please check. Yes, 15,000 for raw materials, then 2,500 for wages, sorry, 1,250 for wages and 2,500 for overheads. You're getting the total amount as 18750. After that, just check these values individually also. Just writing here for your reference. Okay, the next element is debtors, sorry, finished goods first, and then we'll come to debtors. With respect to finished goods, we take them at the cost of goods sold. So the value will be 5,000 into 4.5, and then finished goods are held for 3 months. So this will be multiplied by 3 and you get the value of finished goods. So debtors are allowed a time period of 3 months to make the payment. So since no selling and distribution expenses are given, we will take the debtors also at the cost of goods sold. Amount is the same. You can total this up and you will get the amount of gross working capital. Please add it and tell me what is the amount coming to. Two zero three seven five zero. Okay, just write down the amount here. 203,750. Yes. Okay. Now we move to step 3, which is the estimation of net working capital. So first, we calculate the amount of current liabilities. Creditors are for raw material, so I'm just taking first the raw material cost here, and then let us see what is the period given for payment. Credit allowed by suppliers is for 2 months, and wages and overhead payment, the last line, you are given 1 month to make the payment. So this payment period will be taken at on 1 month basis. So credit payment period was 2 months, and for wages and overheads, outstanding wages, you can write it like this. So this is the working capital requirement. Just have a look at the steps and how the calculation has been done. I'm repeating.
Can you please
Yeah,
show the
sorry.
question once?
तो जो कस्टमर्स के लिए पेमेंट पीरियड था वो 3 मंथ्स था. फॉर बिजनेस द क्रेडिट is given for 2 months and wages and overheads are paid after 1 month. So I'm coming back to the last step